Hello, and thank you for listening in to the On the Market presentation. My name is Clive Beattie. I'm the Chief Financial Officer and the Acting Chief Executive Officer at On the Market. And On the Market, who are we? Well, we're a leading UK property search portal. We're majority owned by UK estate and letting agents. And what we do is look to connect two very large markets. On the left-hand side, agents, as we said, and new homes developers. And they look to list their properties on OnTheMarket.com. And on the other side, consumers, people looking to buy or rent properties, and they will come to the portal and search for the properties that they like, and through us can get in touch with agents or new homes developers. The market is a large one. If you look at the agency market, there are something like 18,500 agent branches across the country, and most of those are very small. So firms with 1, 2 or 3 branches make up the majority of the market. So many thousands of agent firms with about 18,500 branches across there. In terms of the market size, and these figures are pre-COVID, but circa 1.2 million sales a year taking place, 2.4 million lettings taking place. So a lot of transactions, significant number of consumers looking to find the property they want to sell, let, rent or buy. In terms of our history, On the Market, the concept was back in 2013 and started the portal development in around 2014, but launch of the actual portal itself was January 2015. And we came to the market then. We came with a few differentiating features. One, of course, was our agent ownership. In those days, we were a mutual, so 100% owned by agents. But we also had support from our agents, such as new and exclusive listings. I'll touch again on that, but really what that is some of our agents choose to load their new instructions onto OnTheMarket.com before they put them on competing portals, which means that if you're a consumer, if you come to our portal, our website to see properties, you'll get the chance to see properties before you can see them elsewhere. And obviously that's good for buyers because you want to be at the front of the queue. You know, as soon as a property that you're interested in comes to market, you want to be able to contact the agent and start talking to them about it. We, for 3 years, ran as a mutual, but the decision was taken to actually list on AIM, which happened in February 18. Really, we needed some capital. We found that it's very difficult to compete in a market that has basically 2 other very large players, and we needed more capital, both to grow the size of the team, but importantly to spend on advertising and marketing, to make the brand, the consumer more aware of our brand, get more traffic to the site, to generate more leads back to our agents. So that happened in February 18, and therefore at that point we raised £30 million. So our agent ownership went to 70%, with the other 30% being in the hands of institutional and private investors. At that time, we only had about 5,500 agent branches listed on the portal, and that really wasn't enough, because if you can imagine, as a consumer, when you look, you want to see a lot of content, lots of properties to choose between. And the reason we therefore floated was to give us the firepower to grow that substantially. And the way we did that in the first year was actually to allow agents to join us free. So they came on free introductory offers, didn't have to pay to list their properties on the site, and we therefore saw very rapid growth. And actually, from the 5,500 within a year, we're up to about 12,500 branches, which I touched earlier. The market is probably about 18,500 in total. But actually, even the largest player in the market at the moment, Rightmove, only has, well, a little under 16,000, 15,700, that sort of number. So no one actually has the whole of the market. And actually, that's also important because, you know, it means if you're a consumer looking for properties, you've really got to be looking on 2 or 3 of the portals at least, because you won't see them all in any one place. And from a buyer's perspective, from a seller's perspective, a vendor perspective, you know, what that means is actually it doesn't matter so much which you are on. If you're on 1 or 2 of the portals, your property will be viewed by people. They are looking on all those properties. Rolling forward again with our history, that was 2019. So we'd seen a lot of growth in the scale of the portal from a content perspective. But during 2019, we then, that sort of growth flattened out and plateaued a bit. Save that we did start to bring in September new homes developments on site. We started with Barratt, one of the leading players, and since then we've had others, Persimmon, Miller Homes, a variety of others. And that's again important because many buyers will want to see, you know, what choice they have, both new home developments and second-hand properties. Some people only want a new home, some people only want a period property, but most people would like to look at all of the market and then choose what suits them best. So that was important for us. And then as we came through to the end of our financial year in Jan 20, we saw actually very encouraging operational growth on the consumer side. So visits were very strong, the traffic to the site, consumers looking at the property, and the leads, which are the return on their advertising that we send back to the agent. So a lead will be where if I come to look at a property on the site and I either click through to send an email to the agent, or I dial the number to call the agent to speak to them, those qualify as leads. And that ultimately is what the agent pays for advertising for, get that lead back when he advertises his properties or her properties on our site. If I look at some of our metrics now in terms of the scale we've reached, I mentioned 12,500 branches listing. We've now, since September, brought over 1,200 new homes developments listings on the site as well. So substantial content to look at for consumers. We've got over 30 million website visits in January 20, which is our record. But actually, more recently, we've in June just gone, we've had 134 leads per advertiser, and we had something like 1.8 million leads in total in June. And those are new records for us, and I'll touch on those again. We also have now something like 9,000 branches paying. You'll remember we grew very quickly at first by free offers. So what we've obviously been doing is over time looking to convert those as they come to the end of their free period, convert them onto paying tariffs, either at discounted rates initially with the view to getting them to full tariff, or straight to full tariff contract. One of the unique things we have is the ability to offer new shares to agents who do join us on longer term full tariff contracts. So we have authority to issue a further 32 million shares to agents such as that. And I think that benefits us all. Obviously, we've got a very close alignment with our agent shareholders. We've committed to only fair, sustainably fair prices and therefore not outrageous price increases for listing as we go forward. But we actually get a lot of support from our agents in return. Things like new and exclusive that I've touched on that they do for us and they don't do for others. They help us by setting up, register people onto the OnTheMarket website, those sorts of things. So there's a very close affinity, and we think having that large and growing shareholder base of agents is actually a very important differentiating factor. If I touch on the model, the sort of revenue charging model, agents and new homes are similar. So effectively, an agent will pay per branch under a listing contract, and they will then display all the stock they have, sales and lettings, and they will pay a set fee per month to do that. So our revenues are not directly affected by level of transaction in the market or numbers of listings that an agent has at any time, just to do with a monthly subscription fee. And that will be determined by the scale of the firm, and the location of the firm can affect the charging. Thereafter, we provide within the listing fee a number of free market efficiency tools, reporting tools, things where they can check their performance against their peers and competitors. But we also supply additional branding products, and those can be where they would pay to highlight spotlight properties or to have banner advertising for their firm when certain search terms are put in, those sorts of things. New homes are similar. The difference really is for our agents, and particularly our shareholder agents, we actually have some very long-term contracts. In our longest are actually 5 years from start. So actually we have contracts now till 2023, 2024 that underpin our revenue. So a substantial part of our revenue base is under those long-term contracts, which gives a nice stability, annuity income. New homes developers have a very similar model in terms of listing contracts and then the sale of additional branding products, but they don't tend to be, they're not shareholders, and they don't tend to have such long-term contracts in place, but otherwise very similar. The third and evolving part of the revenue stream for the portal is we've now got a very powerful distribution platform that, as I say, the agency market itself is very fragmented, lots of small agents all over the country. They're very hard to market to them in any scalable way other than through a platform such as ours. And so we are now starting to identify new products and new services that we can sell through our broad distribution platform. And those will be sold outside of the listing fee agreements and therefore available to agents. If they want them, they can pay for them, and if they don't, they won't. But I think that will become an increasing part of our revenues in the medium term once we've got fully monetized the scale, fully scaled the portal and the listing itself. So this is a more graphical way to demonstrate actually the change since we've come to market. You can see launch in January 2015 through till early 2018. We came to market in February 18. You can see that actually the content, the advertisers was broadly flat. Website visits didn't grow dramatically, but actually you can see the difference it can make once we were able to offer free contracts to agents and grew the scale of the advertisers significantly. And also following on from that, using that additional content, but particularly using increased marketing and advertising spend, we're able to dramatically increase the number of consumer visits that we get to the portal and the apps and so forth. Touching on the opportunities, as I say, to leverage the platform now it's established in other products and services. The first one we've done is we made a small acquisition in December 2019, a business called Glanty, but its first product is a product called TechLet. It's an automated online lettings platform, and it brings together all of the parties in a lettings process, which can be a lot. You've got the agent, obviously, themselves, you've got landlord, potentially multiple tenants, potentially multiple guarantors. So a range of different people, all of whom have tasks to do at different times, all of whom have to sign and documents to read and file. And this just makes it much more efficient all in one place where they can all access and see what they're doing and sign electronically, all those things. So that we're very excited about as a product. The technology we think is good, and it was also set up by lettings agents. So actually, they knew the problems they were trying to solve. They knew the inefficiencies in the system, and we think this is a very interesting product for us. But actually, thereafter, there are a whole range of things you can look to leverage on the back of those products. So on the right-hand side, you'll see some of the areas that we've touched on. But you can imagine that if a new tenant is looking to rent a property from a landlord, he might need contents insurance. They might need home management areas such as boiler maintenance and those sorts of things, gas safety certificates. There's all sorts of bits and pieces around a home move, be it a let or a sale, that we can start to offer solutions and products through our platform at the time that people are transacting, either in sales or lettings. So it's those sorts of areas that into the medium term, I think you'll see us increasingly push into. We want to do it in a way that is agent friendly. We want to share the opportunity with agents rather than take opportunities from agents, because many agents have the capability to do some of these things themselves already. So we'll work with them to try and do that in the right way. But nevertheless, with the size of our platform and the size of the consumer traffic, we think there are a lot of opportunities to do things in a way that are good for us and good for our agent customers. Our year end is January. So if I just take you through now the results we had to Jan 20. At the top, you'll see revenues grew 32%. This was the first period in which we started to convert people from the free offers. So that's what's mainly driving the revenue growth. As we went through the year, month on month, the revenues were growing as more and more conversions happened. Coincidentally, the average branches listed over the year was also 32% up. But you can see some of the network benefits of having these increases, because actually the traffic, the visits were 49% up. And the leads to advertisers, the important thing, as I've highlighted, what they're paying to advertise for, was 75% up. So, those sorts of metrics. And in terms of numbers, the leads on average for the year to Jan 20 were 96 per advertiser, up from 55 the year before. And actually, 96 is, we think, a very credible return for the tariffs we're charging, the advertising cost of listing for an agent on our site. So now we're very encouraged to have got to those levels, because actually for the first time I think we're delivering value in return that a portal should be, and that is because we've achieved this scale both of listings and of visitors and traffic to the site. I've mentioned that we're agent owned, and we think that's important. I'm going to touch on that in a moment when I look at COVID and some of the implications of COVID. We've seen a continued growth in paying customers, and that's just, as I've said, we're converting those who have been with us for free. More and more of those as we go forward converted onto paying. And we've started, the other pleasing thing in the year was, as I say, late in December, late in the year, we started our push into these ancillary products and services, tech-enabled offerings that we can push through the platform, and that was a TechLet product we've discussed. Looking at the numbers, the bottom half of the table, the operational metrics I've just touched on. But you can see at the top half, there you can see the revenue growth from 14 to 19 in round figures. You can see we're still loss-making for the year, 7 million at the adjusted EBITDA line. But actually, I'll come back to that. That hides, if you look at the annual figures, that hides what's happening as you go through the year, because as I say, each month our revenues were growing, and therefore our losses get smaller. So a lot of that loss was earlier in the year. And you can see we were still had net cash of 8.7 million at January 20. Actually, at the end of May, we still had about 8.8 million of cash. So we've managed to conserve our cash position since this date. COVID-19 has clearly affected everyone, in every industry. Agents were no different. Although we are not directly linked to transactions, as I mentioned, it's a monthly fee. Clearly, when the strictest lockdown rules were in place from the 23rd of March, it stopped agents being able to do any business. So that you couldn't buy or sell houses, you couldn't let, rent, and as their revenues are entirely dependent on those activities, they only get paid. In the main, they only get paid on a completion of a transaction. Clearly, stopping those transactions in their tracks meant that agents were in a very challenging position for their own cash flow. So we actually decided the right thing to do was to give discounts to our fees. Technically, because we're not linked to transactions, we don't need to do those things, but we felt it was the right thing to do for our agents. And therefore, we also had to take measures ourselves to conserve our own cash, make sure we survived the COVID crisis and came out as strong as possible on the other side. So therefore, because our revenues were down, we cut some of our costs, we cut headcount costs, we did make use of the furlough scheme, but we also cut discretionary marketing quite substantially. So we're comfortable with the actions we've taken. We took early and we took enough action, we think, to conserve our cash, see ourselves through. But actually what has happened, we think, is very encouraging in terms of what it means for the portal, because since the 11th of May, when the agency markets reopened, there was a partial lift of restrictions. Clearly there are still social distancing measures, they can't operate as they used to do. Nevertheless, they are able now to get out there and start doing transactions. And actually the markets have been very busy. Partly we think the backlog, all the transactions that were stopped dead when the lockdown restrictions were put in place. But also actually there seemed to be a fresh range of transactions, people coming to market, perhaps driven by a review of lifestyles because of COVID. So people looking for gardens, people looking for slightly larger properties, perhaps studies, so home working is more viable, perhaps moving out of town and into more rural locations. We've seen new instructions coming to site, back to similar levels as they were pre-COVID. The actual stocks on the site are slightly up, but that's partly because it takes a bit of time to clear as transactions progress through. But actually just last month, we saw a record delivery of leads back to our agents and our advertisers, 1.8 million in the month, equivalent to 134 per advertiser. And if you remember, I talked about for the year as a whole, to Jan 20, we had 96 per advertiser, so significantly up on that. And as I say, I think all those things, given that we haven't had to spend on advertising, that shows me that we have got a portal now that has an engaged consumer base, that the consumers that are coming to our site are those that are actually active in the property markets at the moment. They are the people looking to buy and sell and rent and let properties, rather than just casual browsers, because we're getting substantial numbers, visiting 1 million-ish a week, and creating a lot of leads back to our advertisers. So I think that is places in a very good place. Notwithstanding that, as I've said, we've been giving discounts to our agent customers. We initially had a 3-month discount at 33%. We've extended that for 2 more months. So our revenues have been reduced because of those discounts. But as I say, we've taken appropriate measures on the cost side to see us through. I think I would mention, as a financial stock, we have withdrawn our financial guidance. It's very hard to know where the year will come as a whole, but what we're seeking to do is operate to conserve our cash, and then once there's more stability or more certainty on things going forward, we'll be able to look further out into it with a bit more certainty. So I think there's been a lot of change, and we've actually seen groups formed of agents with a substantial number of branches across the firms in those groups that are looking at their portal choices and looking to determine what they're going to do next. I guess the highest profile one is something called Say No to Rightmove. It has a website, saynotorightmove.com. but they are looking to see a fundamental change in what happens in the portals market, rather than a return to what was a very high pricing in their eyes for that product from Rightmove. So I think that gives us an opportunity, and the reason I say it's an opportunity is that what we found is we are clearly differentiated from the other two portals through our agent ownership. One is a fully institutional owned business. The other actually is part of a private equity house, whereas of course we have something like 65% of agents as our shareholders. And that has been something I think the agents have focused on much more. And as we come out of this immediate crisis, I'm hoping that that will actually stand us in a very different place when they make their portal choices. Here's just a few examples of that strong agent support that we enjoy and that enables us to prosper. There are many more on our OnTheMarket expert website where we have testimonials, but these are some of the groups that have chosen to support us, and we're very grateful for that. And just coming back to the new and exclusive and how they can actually proactively support us in other ways. So here, what the new and exclusive is, as I've mentioned, they would list their new instructions with us 24 hours or more before on either Rightmove or Zoopla. And we use that very much when we market to consumers, because actually, as I say, as a buyer, you don't want to miss out, or if your potential tenant, you want to get to see the properties as soon as possible. And this way, you'll get an email from us as soon as a new instruction comes to market, by signing up with us for a property alert, for putting in your criteria for your search. And even if that property were to be on Rightmove or Zoopla, it wouldn't be so for another 24 hours, perhaps longer. And therefore, for those who are with us, they get that chance to contact the agent and start progressing the transaction sooner. I mentioned earlier that if you look at the year as a whole, we reduced the amount of cash. We made a loss of 7 million, but I also mentioned that was very much first half weighted because of the increased revenues went through the year. So here you can see that illustrated, and also in the top bullet point of that 7.1 million loss, 5.6 was in the first half, and only 1.5 in the second half. So by year end, because every month our revenues increase as we continue to convert people from free and discounted rates to full tariff, our cash burn, our losses get much smaller each month. So that was the position coming into our current financial year 21. Of course, COVID has changed that, but actually I think whilst it has reduced our revenues, we've been able to respond on our costs. So there isn't the cash burn concern. It's more that we don't yet know where we'll end up for the year on the current year revenues, because until the market stabilises a bit, we won't be able to get back out there. Firstly, withdraw over time the discounts we've offered our customers, but secondly, start to restart that growth momentum and convert those who are remaining. And we have something like 2,000 or 3,000 on discounted rates and 3,000 on free of charge. So it's substantial opportunity to convert a fair number through, which will be a meaningful rise in our revenue. Touching on those numbers then, so as I say, in the end of May, a little over 9,000 on paying contracts, but 2,000 or 3,000 of those on discounted contracts. And at the sort of average rate across those 9,000 we might enjoy if they were all paying full tariff, that would probably be something in the order of £300 per agent branch per month. And if all 9,000, if all we managed to do was convert those 9,000 who are already paying something, and who are obviously enjoying a better return in terms of the leads we're providing through our enhanced operational performance, if they paid us £300 a month, that would be in the order of 32.5 million of revenues just for the listing service from those agents alone. If the other 3,000 plus who are already with us on freeze, all paid full tariff, would probably be at revenues of 45 million. And this is going to give us a significant profit and cash base, which to invest. Initially, we'd invest that in continuing to grow the marketing, the team, support our customers, but thereafter, free cash to invest in some of these new opportunities to develop and deliver new products and solutions to our paying customers. All of that is before any further market share growth. I touched on the market share being around 18,500. And obviously there are other areas we've now started, new homes developments. That can be a very meaningful supply of a meaningful revenue stream. We've started the same way we did with agents. We're growing the content, but once we've got sufficient content and therefore starting to deliver credible return with the consumer traffic back to the new homes developers, we'll look to increase the monetization from that stream as well. The 32 million shares I referred to earlier, so we have something like 3,000 agent firms with around 6,000 branches. Actually, recently during COVID, we released a couple of new offers. and we've been very encouraged. So under those offers, which started at the end of April, we've got a further almost 500 branches that have joined now, who are new shareholder contracts, full tariff contracts, starting paying with effect from September, but adding to our shareholder numbers. And we think that's important, and we want to see that more. And the way those are structured, although we give shares alongside them, the shares are linked to the revenues we earn under those contracts. So really, it's an accretive share offer. We're acquiring business on an accretive basis. So summarising, I'll start top left and go round to the right clockwise. Firstly, I think it's if we ignore COVID, it's a very positive market for us. It's a large fragmented market, but there has been a shift to online. That shift continues, although to a large extent, most of the marketing is now online rather than paper-based. So that puts us in a very good position. The actual housing market metrics themselves, before COVID, actually, January, February, early March this year, very strong signs of good transaction levels, strong markets, clearly substantially impacted by COVID. And although actually very strong again now, still not clear. We hope that will sustain itself through. I think for agents, as long as they are able to transact, the levels may go up or down a bit, maybe a bit weaker from time to time, but that's the lifeblood of an agency. It's actually transactions. That's how they get paid. The complete shutdown was incredibly challenging. But as long as we see a level of transaction continue, I think most people, fundamentally, there is more demand than supply of housing in the UK. So fundamentally, the market will be a good one. It's just been impacted in the short term. On the growing customer offer, obviously, we target not only the fact that they are our own agent shareholders, but we are offering sustainably fair fees, which we think sets us apart from the other portals. We think is attractive to agents. So we're not just helping them in the short term, but we're helping them into the future with a fair offering for the listing. As I say, we'll add additional products and services to them and others, and those will be charged at market value, whatever that is. But in terms of the listing service itself, we have caps on our increases in our contracts so that they stay at a fair level. In terms of the board, we've got an experienced board. We have good revenue visibility. As I mentioned, a lot of our contracts start as 3 or 5 year contracts, giving us a lot of stability in terms of our underlying revenue base. And I think, with our net cash position and the actions we've taken, we are stable and getting through the COVID crisis and be ready to start, hopefully regain the momentum we were showing at the early part of this year, pick that up again when the market stabilises. And I've touched on the 65%, but we do see that as key. At the end of the day, we're the only portal that has this agent ownership in that way. And I think that will enable us to continue to engage with and support our agents, but be supported by them in return. So in summary, I think a very strong year in financial year 20 for us operationally. The portal is at scale, the portal is delivering, the return to the advertisers increasing, we're getting millions of consumers looking at the portal each week, and we're generating millions of leads for our advertisers. COVID did present challenges. Those challenges are still ongoing to an extent, and we'll continue to monitor that. But at the end of the day, we still think we're in a position to come through COVID, out the other side, and hopefully placed as well, or if not better, through our differentiated proposition. So ultimately, we think we've done the right thing for the agents during the COVID crisis, and the focus that they have now got on the fact that we are, one, performing much more strongly for them as a portal, and two, have their interests very closely aligned with our own through the agent share ownership and our desire to increase the agent share ownership. We think that sets us apart, and we think it's going to be a good base for us if we start to move out of the COVID crisis. If you want to, you can look more on investors at OnTheMarket.com. We're on Twitter, LinkedIn, and Facebook. So please follow up. I'll be around during the rest of the conference and available if anyone's got questions. But thank you very much for your time today.